Hey guys, hope everybody's doing well. Today I am going over probably what's going to end up being my favorite and possibly my only income fund going forward. Okay. My strategy personally is changing and it's evolved over time. And I'm doing what's right for me. Okay. Someone in the comments, if you missed my QYLD video, JEPI/QYLD video last week, someone in the comments, pointed out that I was probably wrong in me saying that JEPI pays out more than it earns. After he explained it, he wrote me up a nice comment and explained it step by step. I understand it a little bit better now. And, QYLD probably isn't paying out more than it earns, but it's very complicated, extremely complicated, to understand how they actually, pay out their dividends to their investors. I'm not a financial expert. I'm just some dude on YouTube, sharing his journey and, sharing my thoughts on some of these, products that are out here. So, thank you to, oh man, I done forgot your name, but he left a long comment down there on that JEPI video. I'll probably copy and paste it in the community tab so that everybody can read that. But I probably shouldn't have said what I said on QYLD. It was just the way I was feeling at the time. And, it's probably not paying out more than it earns. So with that out of the way, if you're new here, please like, share, subscribe, do all that good stuff. Today we're going over one of my... Did I already just say this? I feel like I'm just saying this over again because this is take 2. Probably my only income fund going forward. My strategy has changed. I've evolved over time, and we'll go over it. If you're new here, like, share, subscribe, do all that good stuff. In the comment section down below is pinned with all my affiliate links. If you are an Amazon shopper, please use my Amazon link. Because at no extra cost to you, any items purchased through that link, I get a small commission on qualified purchases, and it's just a win-win situation, and I would appreciate it. So what income fund am I talking about? A lot of you probably guessed it since I did a JEPI QYLD video last week. I'm doing a NUSI video this week, and that is NUSI. I reviewed this one 6 months ago when it first came out, probably more than 6 months ago, and I'm back to look at it again and see if I can explain it a little bit better. But it's furnished by Nationwide. Like, Nationwide is on your side. I don't know why I just sang that, but I did. And it's a risk managed income ETF. Okay. It does have a high expense ratio of 0.68%. This one is actively managed like JEPI is. QYLD is passively managed and NUSI is actively managed. So you have 2 active managements and a passive. It's running about $28 a share as of this recording, roughly. And it has a distribution yield of 7.8%, and it contributes that distribution monthly. So we'll go down here. We'll talk about the fund description. So it's an income solution that targets high current income and seeks to provide investors with a measure of downside protection in falling markets and potential for upside participation in rising markets. So how do they do that? Well, NUSI is extremely unique, as far as these 3 are concerned. JEPI, they just do covered calls and hold long stock. QILD, they're just strictly a covered call fund, period. And NUSI is a hybrid, right? They have a downside protection element of them, which has actually allowed them to outperform in a big way, especially going back to March of last year. So this fund has been around since about December of 2019. And it's getting a little bit more mature as people find out about it, especially now that bonds are probably, one of the riskier, believe it or not. Government bonds are probably pretty risky right now because the interest rates are so low. Those that don't know, bond funds, because interest rates are so low, if those interest rates were to rise, your price or the equity you have in that fund will actually drop, and dramatically in some instances. So what Nationwide has done is got a hybrid equity fund that tries to provide some stability in the equity market and income as well. So they do a covered call and a protective put. So it's income generation plus downside protection. And we'll just watch this. This is probably like 30 seconds on Nationwide's website of how the strategy works, and we'll talk about it. So here's how it works.
The investment process begins with the purchase of actual positions that replicate those of the NASDAQ 100.
So they actually buy, they try to buy all the stocks that are in the NASDAQ 100, and they hold them, they try to match the weighting of the NASDAQ 100
index. Next, the fund managers sell covered NASDAQ 100 call options, whose strike price is above the current trading price of the index.
That's important. So the fund managers sell covered NASDAQ 100 call options, whose strike price is above the current trading price of the index. So QILD sells at the money call options on the index. JEPI does something totally different than these two. But this is an important difference between QILD and NUSI, is that NUSI sells their call option above the current trading price of the index. What that does is it gives them a gap to where they can participate in the upside. Even though they're still capping their upside, they still have some room to participate in the upside of the index.
The intent of the covered call strategy is to generate income through the premia received. The managers then purchase NASDAQ 100 index put options to fully hedge the portfolio and to seek to minimize losses in the underlying equity portfolio. The net credit, the difference between the proceeds from the sell of the calls and the cost of the puts, is returned to investors as monthly income.
So then they buy with the proceeds that they sell the covered call from, they buy a protective put. Okay. And what that does is it hedges, or it protects the fund in case of a market drop. So I'll try to explain this in a option chain. Okay. So here we have an option chain of QQQ. This is not what they use. They actually use index options. But this is going to give you the gist of it. So let's say, QQQ is selling for $334.48. And they go down here and they'll sell a call. This is the option chain. The calls are on the left. The puts are on the right. They will sells are on the left of the option chain. These are two prices. So they sell the 340 covered call. They'll collect $5.14 from selling that $340 call. So they'll take part of that, and then they'll come up here to actually they'll probably go a lot higher, but they'll buy a put that's a lot lower than the current price, and they'll spend, just say $450. I made a bad choice here because I should have gotten cheaper out here, but it's cheaper to buy the put at $453 than say they collected the $514. So the difference between that and that is what they pay out to the investors. And what would happen is the purchase of this put that's out of the money, if this were to drop, if the shares were to drop, this would increase in value. So see how it gets more and more money, more and more valuable the closer it gets? Well, if this were to drop, then these prices essentially would move in the opposite direction. So your bought put would go up in value if the stock dropped or the index dropped. Okay, so that's where the downside protection comes in. Now, I was reading somewhere the way Nationwide does it, which is nice, is right here. The fund sub-advisor generally utilizes a proprietary systematic model to manage the fund's options position in an objective rule-based manner. Although the sub-advisor may actively manage the written call options prior to expiration to potentially capture gains and minimize losses due to the movement of the NASDAQ 100. So they're literally managing the options instead of just, for instance, like QILD, their rule is they're going to buy it back the day before it expires. That's their rule. That's all they're going to do. With NUSI, they can pull off or buy back options and let the fund run, or they can probably take off the put and minimize losses that way. So I like that they can actively manage the call option. So let's see what else. I think that's all I had. And I mean, NUSI's why NUSI targets high monthly income, seeks downside protection, potential risk mitigator, seeks to limit duration and interest rate sensitivity risk. And this is what I was talking about. Bonds right now are very risky. Government bonds especially are very risky because any uptick in the interest rate, your value in that bond fund or whatever is going to drop dramatically. So how to use NUSI, a complement to a traditional 60-40 allocation, a bond alternative that may provide investors with greater flexibility across different market cycles, a volatility dampener that may augment existing investment allocations, and a tool that may aid in supplementing current income. And I am going to be using it as a bond alternative, basically, because I'm going to be putting some cash needs into it. I don't suggest that you do this, but I'm going to be doing some cash needs into NUSI, and that's all I'm going to do. I'll go over my strategy in March when I do my dividend income update, and I'll share everything then. So that's NUSI. I like it. I like it for the downside protection, especially right now. We're pretty elevated. Everybody would say we're due for our drop. At least in something like NUSI, you'll have some downside protection. So I will go into my ETF channel and we'll look at how this compared to QILD. And we'll chart 10,000 invested. This should be from December 2019 on. And we'll look at it, NUSI, since, December 20th, 2019, returned a total of 22.32%, average annual total return of 19.23%. Whereas in QILD, total return was 11.81% and 10.24%. So if you look at it here, the black line is NUSI, and this is where you'll see the protective put in here, or put into action here. You'll see QILD probably dropped 30%, and that, if you got the stomach for it, then that's one thing. But if you really don't, NUSI really performed pretty well. I think it only dropped about 12% during the month of March of 2020, and it really just took off from there. This is concerning a little bit. They probably made a mistake and took off a put, or took off the call early, and they paid for it there. But essentially, it's been okay since. And you can see, look at this. You can see the drop in QILD, and then the spike in NUSI. It's kind of interesting how it's almost mirrored. Now, the next thing I wanted to show was which was very surprising to me, was NUSI versus the S&P 500. And NUSI kept up very well against the S&P 500. For a little while it beat it, but look at this with the S&P 500, because the S&P 500 did have that 30% drop in March of 2020, and NUSI didn't. And it really, it only very recently has the SPY actually went above NUSI, because the SPY in that same time period returned 24.75% versus NUSI's 23.04%. So pretty interesting there that an income fund has kept up with the S&P 500, all because of being hedged. That's really it. Having that downside protection is really what rocketed, or really what buoyed NUSI to keep up with the SPY. So if we ever have one of these again, NUSI could probably jump ahead of SPY again. So again, I'm no financial advisor. If you have any questions, please leave them down below. Like, share, subscribe, do all that good stuff. I know this one went long, but I wanted to get this one out here because it's been a while, and I wanted to let you guys know that this has turned into my favorite because of my overall strategy. So it's personal. I'm not saying this is better than JEPI. I'm not saying this is better than QILD. I'm just saying, for me personally, and what I'm doing in the market and income generation, this is the right move for me. So hope you guys enjoyed. Leave me a comment. We'll talk to you later. Thanks. Bye-bye. I am not a financial advisor. The information contained in this video is for entertainment and informational purposes only. It is not intended to be investment advice. Please seek a licensed professional for any investment, tax, or legal advice. Thank you.